Welcome back to FinScribble. Imagine watching the World Cup while $50 billion silently bypasses every major sportsbook on Earth. Traditional betting shops spent millions on flashy television commercials, yet billions in volume poured directly into platforms like Kalshi and Polymarket instead. Why are sports fans and Wall Street traders suddenly abandoning legacy betting sites for these new digital exchanges? Meet Jordan, an avid sports bettor who keeps getting hit with hidden fees and restrictive betting limits. Then meet Maya, an analyst who realized that prediction markets aren't actually gambling apps at all. Pauses thoughtfully. They are a completely different financial instrument, built on open order books that operate far more like NASDAQ than Las Vegas. Regulators across the country are currently panicking because these platforms have unlocked a multi-billion-dollar financial engine that traditional sportsbooks simply cannot match or stop. Let's break down how this massive shift works and why it changes everything. To understand this financial revolution, we must look at how legacy sportsbooks make money. When Jordan places a bet at a traditional book, he is playing directly against the house. The sportsbook operates like a middleman ticket scalper, quietly baking a hidden fee known as the vigorish into every single line. If Jordan wants to wager on a game, the house forces him to accept fixed odds that favor the bookmaker, while actively banning smart users who win too often. Prediction markets completely flip this dynamic on its head by operating like a modern stock exchange. Instead of playing against a bookie, Maya trades contracts directly with other participants in a peer-to-peer network. Every outcome is represented as a share priced between 0 cents and $1, reflecting the exact real-time probability of that event occurring. You aren't gambling against a greedy middleman, you are trading reality shares with the open market. Why do order books beat fixed odds every single time? First, there is zero house edge because prices are determined by supply and demand rather than a corporate odds maker setting artificially inflated margins. Second, prediction markets eliminate counterparty risk because every contract is fully collateralized on the order book. When Maya buys a 60-cent share predicting a team victory, someone else is simultaneously buying the 40-cent share for the opposite outcome, locking in the full dollar instantly. Third, order books provide unmatched liquidity and real-time price discovery. If a key player gets injured during warm-ups, sportsbooks will freeze betting entirely to protect their own profit margins. In contrast, prediction market shares immediately reprice in milliseconds as traders buy and sell existing positions. Jordan can sell his winning shares halfway through the game to lock in profits, enjoying the exact same freedom traded on Wall Street every day. This massive financial disruption has ignited a fierce legal showdown between prediction platforms, state gaming boards, and federal regulators. Traditional sportsbooks operate under strict state-by-state gambling licenses, paying heavy local taxes and complex compliance fees. When platforms like Kalshi sought federal approval from the Commodities Futures Trading Commission to trade event contracts, it created a chaotic jurisdictional war. Gaming regulators in states like Michigan argued forcefully that sports event contracts are just illegal sports gambling wearing a thin financial mask. However, federal courts recently ruled in favor of prediction markets, classifying these binary contracts as legitimate financial derivatives. This landmark legal victory effectively allows these platforms to operate across the entire country under federal oversight, completely bypassing restrictive state gambling bans. State regulators and legacy casinos are now left watching helplessly from the sidelines, while federal financial law quietly dismantles their long-standing legal monopoly once and for all. The real power of prediction markets extends far beyond simple sports outcomes. Because these exchanges run on standardized financial contracts, traders can now price virtually any measurable event on Earth in real time. Maya uses prediction markets daily to track upcoming presidential elections, Federal Reserve interest rate decisions, global inflation metrics, and corporate earnings reports. Traditional polling methodologies and television pundits are notoriously slow and often biased, but skin in the game pricing creates an extraordinarily accurate forecasting tool. When market participants put actual capital on the line, fluctuating prices aggregate collective human intelligence far better than traditional surveys or political commentators ever could. Major corporations are even utilizing internal prediction markets to forecast product launch dates and supply chain bottlenecks with shocking accuracy. What started as a clever alternative for sports bettors like Jordan has officially evolved into the ultimate real-time financial truth engine for modern society today. So, are traditional sportsbooks completely doomed? Or will they somehow adapt to survive this shift? Legacy sportsbooks still hold massive marketing budgets and entertainment appeal for casual casino gamblers. However, serious sports bettors and financial market traders are migrating permanently to peer-to-peer order books for lower transaction costs, higher betting limits, and transparent market depth. As prediction markets merge sports, global politics, and macroeconomics into unified financial platforms, the line between gambling and investing is blurring forever. Jordan has officially stopped fighting unfair sportsbook vigorish and now trades live outcome shares alongside Maya on open digital exchanges. Whether you are hedging a corporate portfolio against high inflation or trading live World Cup probabilities, prediction markets offer unprecedented access to fair pricing. That incredible 50. As always, appreciate you hanging out today. See you in the next one.